Welcome to another edition of our another session of the foundations of accounting and finance. Yesterday we stopped somewhere here in the last class. That is, we stopped at discussing what is the difference between systematic and unsystematic risk. Let me repeat. Systematic risk is a risk which is sort of common across all the stocks out there. A macroeconomic policy impact, or an inflation's impact, or interest rates impact, etc. is more or less, of course, though it might vary with slight difference in degrees out there, the impact is going to be on the same direction. So these are all what is called a systematic factor, systematic risk out there, or market risk, what we call it. Supposing if you look at a natural disaster that happens, then what happens? It impacts all the stocks out there. When COVID broke down in 2020 March, the entire market tanked on one particular day in the last week of March out. So what happened? It impacted all the stocks at the same time in a similar manner with mild variations out there, but direction was same. So that is what we call it as a systematic risk, market risk. So can I eliminate market risk or systematic risk with diversification? Well, no, it's difficult. Because what happens when you diversify between the stocks, your investment, supposing I have about $10,000, I divide this $10,000 between 20 different stocks out there or 20 different investment options out there. COVID, when it broke down, the market was completely impacted, so all the stocks went down, though it vary in degrees out there, but not much of variation, but all of it went down. So all your investment, your entire portfolio would have gone down. So it is difficult to diversify. So that is what we call it as market risk or systematic risk. So what is then unsystematic risk? Specific to a company. I took the example in the last class of a Remonds. Remonds recently has been in the news because of some kind of infight within the family out there. So what is happening? That is impacting only that particular stock out there. It is what is called as, now what happens if I have $10,000, I will not put entire money in Remonds, I will spread that money into various sectors, various companies out there. So when one company is impacted by what is called as an unsystematic risk, or what we call it as a company specific risk, my other companies are giving me safe returns. So what happens? My overall return is not basically completely eliminated. It is sort of, it dips a little bit. But what happens is it can be reduced. The impact can be reduced by diversification. Can it be completely eliminated? Well, yes and no. That is, you get into hedging and so on and so forth, which is not covered as of now. So basically, understanding what I am trying to give you is difference between systematic and unsystematic risk. Systematic risk cannot be diversified, it cannot be eliminated by diversification, market risk, macroeconomic factors. Unsystematic risk, company specific factors can be reduced, the impact can be reduced to a large extent with the help of diversification out there. Now, the next question that comes in is, sir, how do I measure risk? One of the factors that we use for measuring risk is what we call it as, the same thing I have explained out there in my slides. One of the factors, this is what I explained in the last class. I am going to skip this. One of the factors that we basically use for measuring the risk is what we call it as beta. So what is this goddamn beta? How do I measure beta, etc. out there? Or what is this beta? How do I measure beta, etc., etc. Now let us get to some bit of my writing out there. I am just going to use my whiteboard, sort of try and explain it. When we say beta, beta is what we call as a measure of risk. Now how does beta measure the risk? Beta measures the risk in a relative manner, relatively to the market. What is this relatively to the market? I am not trying to get this. Let me go a little deeper and explain. Let us take an index. It can be your NSE 50 or BSE 30. Let us keep that. What is the index? Index is nothing but weighted average price of the stocks in the index that are part of the index. Let me sort of very crudely explain. Let me again repeat. Let me sort of crudely explain the how is in what is in index. Hypothetically, let us imagine there are only 4 or 5 sectors out there. Let us say there is a sector called what is called as the IT and ITES. There is an auto sector. There is a FMCG sector. There is a healthcare sector. There is a pharma sector. Let us say there are about 5 sectors out there. There can be, you can add one more, 6, manufacturing or engineering, whatever it is, or retail and so on and so forth. Based on the level of trading, that is in a day the volume of trading is there, based on the contribution by each of the sectors on the volume of trading, into the volume of trading, we basically assign what is called as the weights for the sector. When I say we assign weights, we assign weights. For example, I am not talking about a single day, on an average over a period of time specified, that exactly if you look at, they say that IT sector contributes to about, let us say, about 25% of the total trades out there. So weightage for IT sector is 0.25. My auto sector contributes to about 20% of the total trades that happen. So our weightage is 20.20. My FMCG sector contributes about 15%. So weightage is 0.15 for FMCG sector. Healthcare sector, what happens? That is about this is about 60. So healthcare sector contributes another 15%. So weightage is 0.15. I'm not giving you this is all hypothetical. I've just picked up numbers out there. So this 30, 50, 75, 125 is there. So pharma sector 15%. Let us say manufacturing 10% out there. So what happens? These are the weights that I have assigned to each of these sectors. Now I will, in this IT and ITES sector, I will look at which is the stock which is contributing, which are the stocks which are contributing to the maximum volume in the IT sector itself. Supposing I pick up 3 stocks out there, stock 1, stock 2 and stock 3. And I feel stock 1 is contributing to about 60% of this 25% out there. Stock 2 is contributing to about roughly about another 35% of this 25% or 30% of this 20%, and stock 3 is contributing to about 10% of this 25% out of this 25%. Then I will say stock S1 will have a weight of 0.25 into 0.6. What is 0.25 into pardon me? 0.15. Stock 2 will have a weight of what? 30 into 0.25. 0.075, and then the last one it is 10% into 0.25, 0.025. So what happens? I have assigned the weights for each of these stocks. Now what is the weight of the stock? So much. Now I can have, imagine I can have S3, and then in auto sector I will have S4, S5 and then so on and so forth. For example, I have left till S50 and I will have the weights out here. And you have the price, trading price out there, price of each of the stock at every minute out there. So what is it? Weighted average price out there, that is price into weight out there. Price into weight out there is what is called as weighted average price out there, price into weight out there. I will get for each of the stocks. Total of that is what we call it as the index. Price into weight, this is the price. So the index will change every minute. Every minute is too long, it will change every nanosecond when during the trading hours. During the trading hours, it can change every nanosecond because trade takes place at different prices. Now price multiplied by weight, index can keep changing. So that is how basically index when we sort of look. Please note, I have not gone by the textbook definition of calculating the index. I have gone by a very crude definition. It is only to help you understand what is an index, how is index arrived. Can stocks get in and get out? Yes. Because for example, as of now you see that 60% it is contributing, tomorrow it does not contribute anything, and there is another stock which comes in the place of that, yes dash. Now that will take its place, and all these weights also can get readjusted in the process. These weights as of now it is there, but tomorrow auto sector starts dominating, then the weights can change, these weights can also change. So these weights can also change out. So this is a very crude form. I have tried to just explain so that you understand what is the index, that's all. They have not gone by a textbook definition, etc., and this is what is an index. Now I go back here. Now it is always what is called as compared relative to the index. We say the beta of index is equal to 1 out there, always. That means I invest my money, supposing I have about $10,000, I invest in all these stocks S1 to S50 in the same weights as it is given out here, in the same weights as given out here. Then what happens? My return, what I am going to get is exactly going to be equal to the index return. Index is going to give me a return that's exactly going to give equal to the index return out. So we say that the beta of the index is always 1 out there. Now that means the risk of investing in an index is 1 out there. Now what is the risk of investing in a SBI FD? Will it be equal to 1, more than 1, less than 1? Obviously it will be less than 1 out there. What is it? It will be less than 1 out there. Obviously, quite obvious that it will be less than 1 in that case, because the level of risk in an FD is lower than level of risk of investing in stocks in an equity in an index out there. So what happens? The beta of SBI FD, beta, if I have to say that, the beta of a SBI FD will be basically less than 1 out there. So what happens? That is what, so when we say beta, beta is always relative to the market. Now I go back to my slide out there, and then now I go back to my slide out there. So what are we looking at in this particular case? So what are we looking at out here? As you can see on the screen, that is beta is nothing, beta of a particular stock is nothing but the covariance, co-movement of your stock with the market out there, divided by the variance of the market. What you see, that is nothing but the covariance of your stock between the return of the asset I, that is the asset for which you are taking, and the return of the market portfolio with the variance of the market out there. So that is what we call it as measure of risk out there. And that is what we call it as the measure of risk out there. So that is what we call it the beta. Beta is nothing but covariance of the stock that you are investing, say S1, to the market divided by variance of the market. That is what we call it as the beta in this particular case. Now why is beta used? What is the use of beta? Now let us go to the next step. Imagine risk and return are always related. Higher the risk, higher the expected return. So, if I say my investment of SBI FD, then what happens? The return, expected return is lower than expected return of investing even in index stocks, in index. Obviously, because the relative risk out here is far lower than investing in the index out there. Because why? Because the beta of the index is 1. Beta of index is 1. Whereas what is then what should be beta of FD? Less than 1. Beta of SBI FD should be less than 1. Now let us look at, for example, I am going to say you have got an investment option. You can invest in a particular stock out there, stock A. You can invest in particular stock A, it has come out of the public issue, you can invest in the stock A, you want to invest out there. Now when you are investing in the stock A, what happens? There is an expected return. That is, you are going to expect some kind of a return out there. Now what is that expected return? Let us look at what is that expected return. To know that expected return, there should be something first you should know, that is what we call it as the risk free rate out there. Sir, it is always denoted by RF. Sir, what is this risk free rate? Imagine, as I said, with the time value of money, what does time value of money say? Time value of money says that the dollar today is worth more than the dollar tomorrow. Dollar today is worth more than the dollar tomorrow. So why is that? The value of dollar is reducing purely because of what you call inflation. Inflation reduces. Today you pay 100 rupees and buy something. Next year you may have to pay 105 rupees and buy the same thing out there if 5% is the inflation rate, keeping everything else constant. So that is what we call it as today, that is what we call it as the time value of money. Now supposing I say I am going to invest in a government bond, or let us say treasury bill. That means I am investing in what do you call it as a government security. What is the risk of investment in a government security? Risk is nil out there. Risk cannot be there. If you invest in the government bond, you cannot have risk because government has to repay. If government starts repaying, then the country ceases to exist. So government will repay. So if government cannot default. So what happens? The risk associated with investing in the government bond is basically what I have to put it as is nil out there, is basically nil in this case. Now there is a return that I am going to get by investing in a government bond or a treasury bill, and that return is basically to cover for inflation out there. that return is basically to cover for inflation, because I could have bought something for 100 rupees today, I didn't buy, I kept it in the government bond. Next year I take the money, it has become 104. The government bond is giving me some interest, it has become 104. I can go back and buy the same thing at 104, because inflation in this country, inflation is 4%. I am not talking about the current rate of inflation, no, I am talking about in general. So, this is what, and when you invest in this, the guarantee of getting the return is certain, risk is nil. So, this is what the return that government bond and treasury bill give is what we call it as the risk free rate. The return that government bonds and treasury bills are going to give you is what we call it as a risk free rate, denoted by RF as the notation out there. RF as the notation out there. RF is the notation that we basically use out there. Now, what do we do with this? Now, go to the next one. You have invested in stock A, as you saw out here, your investment is in stock A, still your investment is in stock A, you want to find out what is the return. If you invest in stock A, minimum you have to get the RF, that is risk free rate. Minimum what happens? You have to get at least RF. That is the basic level of expectation. Now, plus you have to get something more to compensate for the risk out there, to compensate for the risk, because the investment in stock A, if I have to look at the investment in stock A, is more risky than investment in government bond out there, than investment in government bond. So, you have to get more, little more, expectation is high, you might get it, you may not get it, we will not worry about it, but expectation is there. So, now what is that more that you have to give? That depends on the risk factor of investing in stock risk of investing in stock A. How do I measure the risk of investing in stock A? That is, I will look at the beta of stock A. What is beta of stock A? Beta of stock A is covariance of stock A to the market divided by variance of the market. Covariance of the stock A to the market, market means I mean index, to the variance of the market, where market means I mean the index out there, variance of the index out there. Now, we normally say, use the word market premium. What is this market premium? That is, market premium means the return that market is giving me in excess of RF, risk free rate. Now, I invest in the index and the index is giving me, supposing let us say I invest in index in the I invest my money in all the stocks of the index at the same weights out there, at the same weights that they form the index, or I invest in the index. I am getting a return of about 12%. I am getting a return of 12%. I invest in T-bill, I am getting a return of 4%. So, what is the excess return by investing in the index? The excess return is 12 minus 4, that is 8% is the excess return, or market premium is 8%. That means the premium that I am getting by investing in the market, the premium, that is the additional amount that I am getting by investing in the market, is 8% out there. So, now we go back here. I am sorry. I have to minimum get my risk free rate out here, as I said. Now, but again, there is something called beautifully, there is a beta of the stock out there, of the stock A of my investment out there. Now, let us say my return premium or market premium if I invest in the risk out there, then what is it I have to get? I have not invested in stock A, I have invested exactly in the index out there. So, the beta of the index is exactly 1 out there. So, what is the return I will get? I will get risk free rate plus market premium into the beta of the index. The beta of the index is 1. So, in that case what happens? My risk free rate is 4% I will get, plus beta of the market is 1, and then my market premium is 8% as you see. So, what I will get? I will get exactly 12% out there, which is we saw is the return of the index out there. Whereas, I am investing in stock A. That is, so I will have to get, of course, I will have to get RF. Will I get market premium? Should I get market premium or should I get higher than market premium or lower than market premium? I have invested in only one stock. So, what is the risk of the stock out there? Risk of the stock, as we saw, we measured it somewhere else, we measured it out here in this particular case out there, that is the risk of the stock, we measured it as nothing but covariance of the stock A to the market to the variance of the market. That is how much it co-varies with the market and to the divided by the variance of the market is what we saw as what we call it as the risk out there, beta. We need to know beta of A, the stock A, and then if the beta of the stock A is lower than 1, then obviously it will be what is called as less than 1. If the beta of stock is more than the market return, is more than the market, then what happens? It will be 1 plus something, and then to the what do you call it as the market premium out there, or what we call it as in this particular case I will say market premium. To repeat that, let us say minimum I have to get this, agreed, but I invest in the index, I have to get this market premium multiplied by the risk factor, because I have to multiply it by the risk factor. If the risk factor is lower than 1, then multiply it by the market premium. I will obviously get lower than 12% because risk and return relate. If the risk factor is higher than 1, then obviously it will be more than 12%. Let us say now stock A, let us say investing in stock A, my risk is 1.2, it is higher than the market. 1.2, it is higher than the market. Now, what is the market premium? Market premium is 8%. 8% into 1.2. 8% into 1.2 out there. What is 8% into 1.2? So, it will be 4% risk free rate plus 9.6% out there. That means 9.6 plus 4, that is roughly about 13.6% is the expected return. Please note, it is expected return. That means it is relative, the risk is relative to the market, because we invest in the market, it is giving me 8% additional to the risk free rate. I invest in a stock which has a higher risk than the market, then what happens? My expected return is higher, that is whatever is the risk factor I multiply it. Imagine I am going to invest in the SBI FD. I will of course get risk free rate RF 4%. RF 4% plus what is the beta in the of FD relative to the market? Obviously, it will be less than 1 because it is not as risky as investing in a government bond, as risky as investing in an index. It is not risk free as investing in a government bond. So, it will have a risk. Let us assume the risk is 0.3. Now what happens? Market is giving me 8% additional for risk of 1. Now risk of 0.3. So what it should get? 8 to the 8 3 24. So 2.4. So what is the total return that you will get? The total return I will get is 6.4% will be my expected return. Please note, it is only expected. This is what we call it as capital asset pricing model. They would have, all the finance scholars will talk about CAPM or capital asset pricing model. Capital asset pricing model says for any investment you should get basically the risk free rate plus the beta of their investment into what is called as the RM, return of the market, minus return of your basically the risk free rate out there. That is what we call it as the risk premium. This is what we call it as the CAPM out there. This is what is the expected return or expected return out there. So how do you calculate your expected return? It is always related to number 1 the market. Number 1, that is market means index. Number 2, the beta of the particular investment, the risk of that investment, in relation to the market, risk of that investment in relation to the market out there. That is what we will take. Risk of the investment B, risk of the investment in stock A or stock E in relation to the market is measured by beta, and then we multiply with the market premium, and this is what we call it as CAPM. Minimum you have to get risk free rate, as you can see this, you see in this particular case minimum minimum I have to get, it's not giving me pointers, okay, minimum I have to get what is called as, in this particular case minimum I have to get what is called as the risk free rate out there. What is extra I have to get? If risk is exactly equal to the market, then it is 1. And then what is the return of the market? What is the return that market is giving me in addition to the risk free rate into the beta? If beta is 1, then it multiplied by that. Beta is less than 1 because if the risk is less than the market, like SBIFD, then multiply with that expected. If beta is more than 1, then naturally it will be the other way around, as we can see here. And that is what we call it as the CAPM or capital asset pricing model out there. That is what we call it as the CAPM or capital asset pricing model, as we can basically see in this particular case out here. This is what we will see. Expected return of asset should be positively related to the risk. Individual will hold risk-free asset only if the risk expected compensates for the risk out there. Expected return on the market is the sum of risk-free rate plus compensation of the risk inherent to the market portfolio, and that is exactly what I explained out there. Risk premium is nothing but a compensation for the risk. How much should the risk be compensated? If it is more than the risk of the market, it should be compensated higher. How much higher? Multiply it with the beta. Beta will be higher than 1. If it is lower than the market, risk of the market, the beta will be lower than 1. It should be compensated by so much. Multiply with the beta that is there out here. That is what we have taken. I have get some examples out here. 7.2% has a historical equity risk premium. The average historical worldwide risk equity premium is 6.9%. Taking into account the number of factors, 7% is a reasonable estimate for to the future US equity risk premium. That is, taking the risk premium 7% out there. So suppose the risk free rate estimated current yield is 1%, risk free rate is basically 1% out there. What is the return of to the market out there? Risk free rate is 1%, beta of the market is 1, risk premium is 7, 1 into 7 plus 1%, 8% out there, and that's what we basically got out here. What I have done, I have explained it in the same way. If your investment is in government bond, imagine investment is in government bond and you want to find the expected return. It will be RF, risk free rate, plus beta, beta is 0 in that case because no risk, into market premium. So it will be only equal to the risk free rate out there. That is all what we have basically got out there. I got some examples. stock of in particular enterprise has a beta of 1.5, higher than the market, and that of Zebra has a beta of 0.7, lower than the market. Risk-free rate is 3%. Difference between expected return on the market and risk-free rate, that is premium, is 8%. So, what is the expected return of the first one, Aardvark Enterprises? Risk-free rate is 3%, plus what is the premium, what is the beta? 1.5. What is the market return risk premium? 8%. 1.5 into 8 plus 3% out there, and that is what you see. Whereas what is the other one? 3% plus 0.7 into 8%, 8.6% is what you basically see out there in this particular case. We move on from here. So, what do we do with this? We move to the next aspect out here from this. Then what is the next aspect? We move to something called as cost of capital and valuation from this. Sir, what is this cost of capital? Sir, what is this cost of capital? Let us sort of see. So, what is this cost of capital? That is, it shows what is the cycle out there. Investors give money to the company, company invests in projects, and then provides some kind of what you call it as to pay cash to the investors out there. Investors reinvest it in financial asset and so on, it keeps going out. Now, for this entire aspect, there is what is called as a cost out. Now, what is this cost of capital? Suppose I say equity. The cost, for example, let us say, let us keep equity aside, let us say debt. I borrow money. What is the cost? The cost of that borrowing is the interest rate that I have to pay on that borrowing. That is what we call it as the cost of debt, is the cost of that particular capital. Now, I have a preference capital, preference share. Preference share also has an assured rate of return. So, the amount of return that I have to pay, the amount of interest that I have to pay on the preference share, on the money that I have collected, is basically the cost of preference share. What is the cost of equity? What is the cost of equity? The expected return, we calculated using CAPM, is one of the methods. Is what we call it as the expected return of the fellow who is investing the money in my equity, in my company's equity. The expected return of the person who is investing money in my company's equity is what we call it as the cost of equity. So, in here there are three forms of capital: preference, equity and debt. Debt, interest rate is always known, so cost of debt. Preference, interest rate is known, cost of preference. Equity, expected return of investors. Expected return, what is the expected return? We looked at calculating the expected return. So, that is one of the methods that we use is CAPM on this case. So, this gives you what is called as the cost of equity. When I say cost of equity, shareholders invest in financial asset, firms invest the excess cash in projects out there, and then they pay dividends, and then it is a complete cycle, it keeps moving on and on in this particular case out there. And when we say expected return or cost of equity, that includes what that denotes what is the kind of money, what is the kind of return that the stockholders are expecting on the kind of investment what they are making. Now, I take an example out here. Supposing a stock of a company has a beta of 1.3. The firm is 100% equity finance, that is, it has no debt out there. It is considering capital budgeting projects that will double the size. Because new projects are similar to the firm's existing ones, the average beta on the new project is assumed to be equal to the existing beta, that is 1.3. Risk-free rate is 1.5. What is the appropriate discount rate for these projects, assuming that the market premium is 8.4%. That means what? Risk-free rate is 5%. Plus minimum you have to get that, plus what is the beta? 1.3, higher than the market. Market return is 8.4, premium, additional 8.4 in addition to the risk free rate. So, what is your expected? What is the cost of your capital out there? What is the rate at which you have to discount all the cash flows that you are going to get on the project? The rate at which you have to discount all the cash flows, the time value of money, discount all the cash flows that you are going to get on the project is at the cost of capital. So what is the cost of capital? 5% is the risk-free rate plus 1.3, that is the beta, into 8.4%. 8.4% is the, what do you call it, as the market premium. So that gives me 15.92% is the cost of this capital, cost of this equity out there. So all the cash flows that I am going to get, I am going to discount it at 15.92%. That is what is the risk-free rate, and I have explained out there. The last aspect that I want to discuss as of now for this class is one of the methods. What we saw is CAPM, expected return, cost of equity, perfectly all right, beautiful. There are other methods for valuing equity, arriving at cost of equity.